traders, I hope you are well. We are back again with another video. And in this video, we're going to be discussing how I add multiple positions to trades. So currently we're looking at the New Zealand dollar yen. And as you know, if you've been following me, for a while now, you know that I got back on this chart after it hitting a daily demand level. We then went down to the H1 time frame. We found that area just before it went into the daily demand. We've got our H1 time. We've got some friction there as well. Not as much friction as I would like, but friction nonetheless. We had a break. This zone was the cause of that break. So therefore, we're going to take our trade when the market comes down to it. And as we can see, it hit it pinpoint perfectly. So let me just get rid of this tool so we can clearly see what's actually happening over here when I added this second position. And let's just get rid of this one as well, actually, just to make it easier and clear. So now what we can notice is that we have a rally, base, and a rally. Now, you know, when it comes to trades, most times I would not be looking to take my entry, for instance, off a rally based rally because they are weaker zones than the drop based rally or the rally based drop. But in this instance, we have context. Number one, we understand that it's just hit a daily demand zone. All right. Number two, we know that it's hit our trigger event. It's breaking past our event twos as the market is moving up. So therefore, with that context and understanding that we have that daily demand is currently in control, it allows us the assumption that if other levels came into play, they could potentially hold because of the context being that the daily demand has just been hit. All right, so therefore we are currently in an uptrend moving to the next area of supply, all right, to then move the market back down again. These areas are simply magnets to each other. Demand and supply are magnets to each other, okay? Once it hits demand, it then has to hit an area of supply. Once it hits supply, it then has to hit an area of demand, okay? So we're just trying to catch those moves in between. So given the assumption now and given the context, we can likely play this trade or at least let the event chain play out to give us some sort of indication if we can actually trigger this trade, right? So as we can see, we've got our rally, base, rally, right? So we have to then wait for the market to come back into this area. So as it did, I went down to the, I think it was... Yeah, it was the, now this is something you have to look at. I prefer a 15-minute event break rather than a 5-minute event break any day of the week, okay? But at the end of the day, if our structure is not forming on that 15-minute event break, then we've got nothing to play with. So then we have to go down a time frame, and I like to go down to the 5-minute. Now, I would never go down to anything lower than a 5-minute to as my trigger event because the noise would be there'd just be so much noise in terms of structure and how the candles are formed at that point. It would be pretty, for me anyway, difficult to try and place my zone at the right point to gauge whether or not it's going to hit there and then potentially bounce off. So as we can see here, if we're looking at this from a 15-minute perspective, we could potentially say that this area here is the 15-minute zone, right? And then this is the breakout, but we don't have any structure below here to then take that trade. Right, there's no structure, so it's not something that I would do. So then I had to drop down to the 5-minute time frame. Let's have a look, see here. Okay. And as you can see, we've got much better structure, right? So if we go, this is where it was, right here. And as you can see, we've got a mini engulfing candle here. The market's come back in, come back out. We've got friction, 1, friction here, 2, friction here again, 3, friction here again of 4. This is delightful. And then boom, we finally have our move up, and literally all black candles out of there apart from this little red candle here, and the market just shot to the upside. So now, being that we're on the 5-minute chart, it would be easy to say that, you know, this is our zone right here. And we could, number one, the reason why I'm picking this zone is because we've kind of got a level test off of here before the market decides to move up, right, and push through here. So level tests are always a good indication of an existing zone, to let you know that it has a bit of weight added to it, right? But with the 5-minute time frames and these 5-minute zones, you don't want to just take this, it's like a 2-3 pip or even a 2 pip zone like this. Reason being is that the market could easily just push through it and then go back up. So, you know, it's still within my risk parameters to then take this whole area, right, just to be on the safe side so it doesn't push through. Then I'm pissed because it's gone through it maybe like half a pip and then decided to push up in my favor, right? So I would rather take the zone with a 6 pip stop and actually get triggered and have the market move in my favor, rather than try and aim for like a 2 pip, it take me out by a pip and then continue in the direction I wanted to go in, right? So now this area becomes my trigger event. Okay, so we've got our structure, and boom, the market came into it and has began moving out of it nicely, as we can see. Let's just take this back over here. So I still play the event chain, guys, right? I'm still playing the event chain. This is the market coming in as event 1, the 5-minute event break is event 2, the market then coming back in to the cause of that event break, which is event 3, and then finally moving out of there again. All right. So currently I have this trade here, stops, my stop loss is right above here, and this trade now is at break even. Okay, so all I'm going to do now is let this play out and see what we can do in terms of a move to the upside. As we can see here already with the New Zealand dollar yen, the market has come in here very deeply, and I feel has consumed all the orders that are left in here. This zone is black for a reason, because it's already been touched, so it's not fresh. And now we have a move up. So what could potentially happen from here? My target is at this blue line. We could simply have a straight move up all the way up to here with, you know, some small pullbacks along the way, or the market could pop out of this top zone here, pull back a little bit, and then decide to push more to the upside. So just going to have to be patient and wait and see what's going on with the New Zealand dollar yen. But at the moment, a fantastic trade. You know, and yeah, everything is looking good with this so far. So let's move on to another trade now where I have added another position, and that would be oil. All right. So oil is a little bit tricky right now because we have this daily engulfing sitting right in front of the potential move to the upside. And as you can see, we've got an indecision candle here. So the market's thinking about what it's going to do. So what I'm potentially eyeing up is that we could have a rally base and a rally to the upside. Or it could just be a rally. Now it's touched here. Now the market's going to move down. Nonetheless, all of my stops are at break even. Now, this particular trade is, how can I say this? It's not the type of trade that I would normally take. I really did think of myself as a bank in this situation and how they actually trade. As you can see, they've got all of their trades kind of roundabout at the same level, push back up, taking profits off, get some more trades in, and then hopefully push the market back up. So let me just get rid of these so we can make life easier on ourselves and see what's actually happening. So number one, our first trade entry was when the market pushed back into this daily area of demand. Okay, so let's just go down to the H1 chart. So this was the first push in, right? Now, I do not like the fact when we have event breaks over 100 pips away. From where this market entered here to where this event break was around 100 pips, right? So I don't really like to wait to see if it breaks it at 100 pips and then comes back down, because potentially what could happen is that the market could then break this event break and then just continue pushing up, and then I'm totally out of the trade. So this is the exception, okay? If the event break is, say, over 90 to 100 pips or 80 to 100 pips away, as soon as the market hits that daily demand area, I'm looking for entry on a 15-minute event break, okay? Now, as we can see here, I think I've shown this to you guys already anyway. Sometimes this is like really difficult to see if you're not kind of like been doing this for a little while. So the market's pushed in here. We've got our engulfing candle here, and that engulfing is broken straight away, which creates a bullish engulfing candle here. The market then pushes down into it, and then that was my entry straight away. Okay, and then the market has decided to push back up. Now, if you do take a 15-minute event break when it hits a daily demand level, only because that event, if you do take a 15-minute trigger event, when the H1 zone is 80 to 100 pips away, you have to watch the market to make sure that it actually breaks this H1 level, because if it doesn't, then more than likely the market's going to push back down and push through here, right? So that's very important to pay attention to. If you have, let me repeat again, if you have taken a 15-minute trigger event as it hits the daily demand zone, instead of looking for H1 event breaks, right? You've taken a 15-minute event break, taken a 15-minute trigger event. You then have to watch the market to see if it actually breaks the H1 event that is that 80 or 100 pips away, because if it doesn't, then more than likely it's going to push further to the downside. All right. So now we can see that on the 15-minute, the market has actually broken it, right? This is good. But now, potentially, it has the means to move back down. And as we can see, we've got all black candles here. We've got this little bit of friction here in terms of demand, but the market pushes straight back down. But what's it pushing down to? It's not pushing down to, it's pushing back down to the H1 level that actually broke it, right? Hold on. Why does it always do this? This is so annoying. So if we go to the H1 chart, let's just get rid of this as well. And get rid of this too. We can now see that this area here would now be our trigger event, right? So let's just make that this would now be our trigger event, this area here, right? So the market will push back into here. But now this trigger event is around, 30 pips. But, because it's come back into this area again, I want to make sure with myself personally that this trade is extremely valid to take for myself, right? Because now I've got myself in a bit of deep shit. Reason being that now I'm taking a same trade that is currently just within my entry and my stop loss area, and I'm going to be taking another trade in the same zone. Now, the only reason why I did that is because the first trade is kind of like, number one, it's still within my risk parameters to then take this other trade. If it wasn't, then I just have to make sure I'll put my stop all the way back at, just leave it where it is, not put it to break even, and just hope that the market doesn't come back and hit it, right? So let's go down to I think it was a 15-minute again. Let's have a look. Nope, it was a 5-minute. All right, perfect. So now this is in the H1 zone, right? So we want to know that this H1 zone is valid to take another trade. So just like the trade that I showed you on the previous chart, we have to then wait for a 5-minute event break, because that's the one that gave us the best structure, right? So we've got our 5-minute event break up here. we've got good friction. The market's moved into it, come out, move back into it again, come out a little bit, move back into it, and it's come out. So we've got good friction at this level. And then finally, we have the move that actually broke it. So this area here then becomes our trigger event. So now I have two trades taken around the same position, right? But still within my risk parameters. If this second trade was going to force me to come out of my risk parameters, I would never take it. All right. But now we have this trade, which is well within my risk parameters. And let's see what the risk is here. There's only like, what, 10 pips. All right. So, it's around 10 pips on this trade. So the market's come back into it nicely. And as we can see, if we stretch this out even some more, the market went back into it further and has pushed out again since. All right. So this is me kind of like trying to be the bank and buy around the same positions. And even if we look at this, right, the banks seem to be buying around the same position, the same area. All right. It just, that's how I just felt at the time. I thought to myself, this would be a really good trade to see if I can actually buy like the banks, start seeing like the banks, and start trading like the banks, like actually doing what they would do. All right. And trying to configure my mindset to how they actually think and how they perceive the market, because they trade very much like us. But, you know, as I said, they need to know that there's a lot of people who are going to be losing in order to get their trades placed. And this is what they do. You know, trade comes down, they place some orders, they take profits off. People think the market's going down, so then they start placing sell trades. Those sell trades then give liquidity to then fill more orders, push the market back up again. They then takes profits off. People think the market's going down again. They start placing sell trades, and then boom, again, get more orders filled till they go, maybe, you know, let's say if they wanted to get a fair amount of orders filled, this is one here, this is another one here, and then boom. It's kind of like a reversal structure. All right. And then hopefully the market would then begin to move off from there to the upside. So that was my thought process behind adding positions around the area where I took my initial position. And I don't suggest that you do this all the time. It's just that I thought differently this time and it presented itself. So I then took the opportunity. All right. But I don't think this is something you should do all the time. You know, have your, when you take your initial trade, have the market come back in, because it could just stop you out. And then you're now stopped out for two positions instead of one. All right. So it's not something I suggest you do all the time. But if the opportunity is there and you are noticing the reversal structure coming into play on the time frame that you're trading on, then if it's in within your risk parameters, then hey, why not take it? All right. So that is how I added multiple positions. I simply would simply be looking for, well, in this instance, it came back down into my area. And I noticed the potential because obviously the H1 chart broke this area here at the top with that event break. So then it came back down to that area. It didn't just break through it. So I was like, okay, I could potentially take another trade here. All right. And then looking at it from like a 15-minute perspective, you can see kind of like a reversal structure taking place here, banks buying and so forth. And on the previous market, it was simply just basing it off, number one, we got context, daily demand has just been hit. Now we're doing a base rally. So we're going to take that base and let the event chain tell us whether we should take this trade or not. Okay. It's the event chain, guys, is the indicator to kind of like let you know if this trade is potentially valid. It doesn't always work, but most times it does. Because I know there's a lot of people out there that are using the event chain to trade and telling me and sending me multiple messages how the event chain is helping them trade the markets and how the event chain is changing their whole perspective of the market. And I'm so glad that I took that time away, that year away, to come back and then deliver this to you guys, because the amount of you that are telling me that this shit is changing your lives, fuck, it's amazing. It's absolutely amazing. So I'm still going to be spending my time for the rest of the day today. I'm shooting this video on a Sunday, probably won't come out to you guys until a Tuesday. I'm going to spend the rest of my day back testing, and I've been noticing so much with the back testing. It's unbelievable. There is a link down below if you guys want to start back testing with TradingView. The thing about TradingView, the free version, is that it only allows you to backtest on the daily, weekly, and monthly. And if you're using a supply and demand strategy, you need to go down to those smaller time frames like the H1 chart and so forth to backtest. So it's only $14 per month, guys. It's nothing. So if you want to backtest this strategy, then for $14 a month, you can backtest this using TradingView, and the platform you may be already used to already, or maybe not. But it's really, really easy. And everybody knows I've just recently moved over to TradingView, and I'm finding it so helpful having that backtesting tool to recreate scenarios so I can learn quicker and begin to come up with more strategies and to help you guys further develop within your trading. So I hope you have found this video informative. I'll be back again with some exciting news actually on Thursday when I come out with another video. I'm just in talks with someone at the moment. So yeah, let's see how that goes. All right. Anyway, take care.